So it's a really interesting time to invest in debt in the U.S. A couple of major things that are making this happen. So real estate markets in the U.S. are generally balanced, which is important because that means there's basis protection in lending, which is a core facet of any lending business. Supply demand is relatively in check, which is good. Equity pricing for core is really high. If you look at what the Odyssey indexes are, they project 5 to 7% returns for 2018, and that's really because cap rates are low even though interest rates have gone up. Bank lending, which has really been the lifeblood of the lending industry since the great financial crisis, is really skewed towards stabilized lending, pulling back from transitional and development lending for reasons that are technical, like risk-based capital changes and regulatory changes, and that's what's effectively created an opportunity for investors to start looking at the debt markets to fill that void where the banks didn't used to be. When we think about relative value at Square Mile, what we focus on is relative value both in historic context, but also relative to the equity in any given transaction. So in historic context, the last dollar leverage points of these loans are kind of similar to what banks used to do before the crisis. So good relative value in historic context, and relative to the equity, given pricing is so high, returns in similar deal profiles are not too far off what the equity is making. So for that reason, we're putting a lot of our money in the space. And I personally think this is a trade for now, may last 3-4 years, not necessarily a long-term business, but when the market opportunity no longer exists, we'll take our money out of this and put it back into equity.